Hello, ladies and gentlemen. I am O'Brien McMahon, and this is People Business. In this episode, I'm joined by Jim Suprenant. Jim is the Senior Managing Director and co-founder of Guggenheim Partners, the investment banking arm of Guggenheim. Jim was one of the founding partners, as I mentioned, and has grown it from 2 people to 120 or so people now. And they've done transactions across industries, across size sectors in the market. And when I say transactions, I mean helping companies buy and sell other companies. We get really deep into this in this conversation. And I've been hounding Jim for a while to come on. I was really excited to finally get him. There's a lot of mystique around how companies get bought and sold. And I wanted to really dive into that for listeners to kind of pull back the veil and understand what sellers can do to package their businesses, what buyers are looking for, misconceptions in buying and selling businesses. There are a lot of misconceptions, but there's a lot of thoughts out there around what businesses need to do. And a lot of them are negative. You hear people stripping costs out of the business, not investing in their people. And Jim dispels a lot of those rumors and had some really interesting thoughts on what people leaders can do to be positioning the human capital side of their business as a strength. Excited to share this with all of you. Hope you enjoy it. Hope you learn something from it. I learned a lot from it. I always do when I spend time with Jim. Here is Jim Suprenant. Jim, welcome to the show.
Thanks, O'Brien. Appreciate you having me on. I know it's been a long time in coming, so I've been looking forward to the discussion.
So I kind of joke about a real life investment banker, but I feel like investment banking is one of those buzzwords that people talk about like, ooh, he's in investment banking, but nobody really knows kind of what investment banking is, or a lot of people don't. So what is an investment banker? What do you do?
So I think the beautiful thing about being a banker, and I've been doing this for 24 years, it's all I know as a professional, is the job changes as you move through the ranks, as you change, as you become more mature. So, an early investment banker, which is right out of undergrad, is someone that's doing the analytics, the tactile work, getting the Excel model done, creating the presentation, assimilating everything that's sort of required for the transaction. Fundamentally, what we're doing is facilitating transactions and assembling teams, around that. As you grow and mature, you're managing the internal team a bit more. You're starting to interact with the client, often first with the finance function, driving subject matter calls. And then as you sort of reach, our mid-level is vice president, you are really a project manager. If you think about the context of making sure the internal team is functioning, making sure you're organizing the client and organized for the client, and also, managing start to finish the cadence of a transaction, which can be everything from outreach to buyers to managing diligence information, working through the legal aspects of a transaction. And then finally, sort of the most senior and evolved level, it's a very nebulous job. I describe it to my parents as I'm a realtor for companies, and that seems to get through it. But, you're an advisor, you're a therapist, you're a negotiator, you're a marketer, you're a strategist, you're sort of a market prognosticator to some degree. And it's, to me, rewarding because it changes all the time. It changes based on client expectation, the market environment, how you define good. And fundamental to all of this is sort of the people element, right? What does that business founder, entrepreneur want to do? What's good for not only the shareholders, but we also talk about stakeholders all the time, the people that work there that have committed to that business. So there is a lot of people element as you think through the arc of a transaction as well.
And just to be clear, when you say transaction, you're referring to buying and selling companies. Like you said, you're a real estate broker for companies, right?
Typically, there's gray area. Sometimes you might be seeking selling a minority stake in a business so it can grow at a more accelerated pace. But generally, you're either selling a portion of a company in a non-control context, or you're selling largely control of a business. And that's the most traditional type of transaction.
Got it. And that's a good clarification, because it's more about selling equity in a company or buying the equity in a company, and you might buy all of it or you might buy a portion of it, but that's essentially the transaction.
Exactly. And then investment banks writ large, inclusive of my firm, can help raise debt, can do other transaction capital markets advice. They could take a company public. But where I've spent the bulk of my career is helping founders and entrepreneurs partially or wholly monetize their business.
That's what I want to spend some time talking with you on today, as we had talked about prepping for this, because a lot of business leaders, with the state of private equity, with aging demographics in our country, like owners of businesses are going to be retiring if they haven't already. And there's a lot of business transactions happening where ownership is turning over. So executives, I would think, should expect that there's a good chance that they're going to be involved in some kind of a transaction. They're either going to be involved in buying a business or part of a business to add on to their business, or they're going to be involved in being sold to somebody else and either absorbed into a different owner or absorbed into a different company completely. And so I'd love to dive into that and kind of explore that a little bit. So first of all, I get, if you want to buy something, if I want to buy your business, I could go knock on your door, I guess, and say, hey, I'm interested in buying your business. But if I want to sell my business, like, where do you even go to find buyers? So if somebody wants to sell their business and they know you and they say, hey, I think I want to sell this thing, like, what's the process look like?
Yeah, if it's a scaled business, and I think the good thing is there are advisors across the continuum of scale. So if you're a small business, we talk about EBITDA, earnings before interest, taxes, depreciation, amortization, as a proxy for cash flow, and just size of business. Revenue is also relevant. But, if you're a business doing a couple $1 million of EBITDA, there are advisors that help those businesses sell or partially sell and find a way to grow and scale to the next stage, often with their first institutional capital. And institutional capital is generally shorthand for private equity. And, as they get larger and larger, the advisor set probably changes. But in our business, we're typically selling businesses that are worth $100 million to several $billion. And there's typically a sophistication. They may have had investors before, but it really starts for us. And there are multiple advisors that could be very applicable to that solution. But, we and others first start with a subsector orientation. So, I drive a lot of what we call our private equity advisory business, our middle markets business, if you will, across sectors, sort of from a management perspective. But day to day, I'm focused on companies in the IT, outsourced services, professional services. So all of my clients themselves are people businesses, right? They're delivering professional services to their end clients, and I'm delivering a professional service to them. And so they may want to start with a sector orientation, find an advisor that knows their sector. To your point, they may want to sell to a strategic buyer. So in my world, all the large, systems implementation firms like an Accenture or an IBM are relevant buyers, or many, many private equity firms are interested in this tech space because of the tailwinds in the sector. And so we interact with them in each process. We know them. We have organized coverage of them through a financial sponsors coverage group. Again, financial sponsors also synonym for private equity. And we make sure, as part of the core function of our job, that we know those buyers, know how they act, know their personalities, can be a good guide for these selling businesses and what's a good fit, what are good structures, who's good at growing businesses. And that's really a big part of a banker's value add. Sometimes businesses just get approached. You have a business, there are close competitors, you know each other, you go to trade shows, you talk over time, there's a lot of comfort, and it just happens one-off as well. And maybe there's just more of a legal aspect from the advisory. So investment bankers aren't always involved, but general, particularly as companies scale, there's a lot of value we add and from a facilitator and guide within the transaction.
Yeah, just tapping into the network that you have. So it sounds like, if I'm going to kind of reframe what you just said, as one of the big keys is finding a partner who has the right network of potential buyers.
That's absolutely right. That you don't, as a seller, your job is running whatever business you're running. And why should you redo the 2 decades I have in your sector or some other advisor may have? It's our day-to-day function, and we can add value because we're experts in that exact process.
Got it. And how do I think about pricing my company? You mentioned EBITDA. Okay, I've got a business, makes $100 million. How do I know what I should price that as to sell it?
To some extent, it's like anything. And to go back to the house analogy, the market will price, any and all assets. Companies are complex and unique, and they are certainly not commodities. So you can't, look at Bloomberg and see what the price of your company is. But that's why we often run what we call a marketed process, effectively an auction. And so we'll position the qualitative attributes inclusive of culture, leadership, the people elements of a business, as well as, the quantitative. What are your margins? What's your growth profile? How are you investing for growth? And then, either, sort of informally or sometimes formally, we'll compare and contrast those elements to other transactions, comps. We spend all our time on comps. What are comparable transactions?
Like real estate comps.
Exactly.
What are other houses in your neighborhood selling for these days? And do they have 3 bedrooms or 4 bedrooms, or do they have the same type of garage that you have? And so that analogy continues to hold. Exactly
right. And then there's a process element of scarcity, fear of missing out, all of those elements as well as you're running an auction analogy, right? That's exactly what we're doing. And so it's the merits of your company. It's the time in the market. It's the process you're running. It's the competitive dynamics. And ultimately that comes to a price. And people are inordinately focused on valuation and price, which makes sense because it's the headline, but it's not unlike sports where XYZ quarterback signs a $302 million deal, but it only has $72 million guaranteed. The team can walk away in 2 years. Structure matters a lot in these deals. So are you getting your cash up front? Does the new investor have preferences that make it harder to drive a return? So valuation is critical, but all the other structural elements that either relate to the risk of actually receiving that valuation and being able to monetize in the future are also really, really important.
So you mentioned, are there constraints that the new investor is putting in place that will make it harder to turn a profit? What might an example of that be?
And I'd say no investor will put a constraint in place that will make it harder to turn a profit. They may put a constraint that makes it harder to get future equity returns. So, what they may do is say, hey, we're buying 60% of your business. You, founder, are getting liquidity. We have liquidation preferences. So in the next transaction, we need to get 1.5 times our money back, 2 times our money back, or we may want a minimum return threshold. So if we sell the business and our collective return is less than 10%, I get 10% no matter what, and you get a little bit diluted. So it's more, how is the future liquidity? And then there's also constraints on decisions around significant things. So levering the business, doing meaningful M&A, hiring at certain levels, particularly in the C-suite, where the investor will have influence because of the investment they've made and how they're vested in the business.
We can already see how the complexity ramps up here and the value of having somebody in place who does this for a living. You had mentioned the people side of the business and looking at some of the qualitative sides. How much does that really play in? Because you hear about companies being bought and you sold, and you hear, oh, they went for 3x multiple of their EBITDA. And that's sort of like how, maybe it's just me, but that's sort of like the vernacular that you're hearing out there on how these things get priced. But how much does the people side of the business weigh into what the ultimate price is going to be?
I think it's significant. If you look at, and it's odd because you're taking a relatively qualitative thing, but I'll come back to that because there are quantitative measures, and then trying to figure out its quantitative impact from evaluation and multiple. But if you look at Peter Drucker's study on culture, and there have been studies on companies within publicly traded indexes that rank in a certain quartile or whatnot relative to great places to work or other cultural measures, there's outsized return for those businesses. So it's proven that culture, people elements absolutely matter. And we spend a ton of time on that as we're marketing these businesses. And we focus on retention. What is the retention rates of the business relative to other reference companies in the space? And that's a good indicator of the strength of culture. And then it also matters. If you're running a people business, for example, a consultancy, and your attrition is ultra high, it's going to be disruptive to your end clients. It's going to impact your gross margins because utilization of those people will be in flux as you're going through transitions and high attrition. And also, if you're losing 25% of your staff every year and you're trying to grow 20%, you have to do on a net hiring basis. That becomes really arduous and you really have to organize around that. So those elements show up quantitatively. Also, you'll hear private equity investor talk about buying the people, buying the team, and they'll spend a lot of time on, are there holes in the executive management team? Are the executives reinvesting in the business and sort of showing their commitment through putting dollars or keeping dollars in the business? Is there a founder that's still driving the business? That can be very valuable as well and really signal a vestedness. Do employees share in the equity, right? What's been the equity strategy of a founder or business owners to include employees in the equity story? If there's broad equity ownership, that's a signaling very positively to a new owner, to investor as well, that people understand the business. They're tied in more of a long-term equity portion of the capital structure into the growth of that business.
Okay. So that I was going to ask you, is that going to be a positive or negative if equity is spread across the employee base? But it's not positive.
Yeah, absolutely a positive. I mean, everything has norms and reasonableness, but if you can balance the breadth of the distribution while also keeping it significant enough to matter, that's a great balance. Okay.
So why do these transactions get such a bad rap then when it comes to the people side of business? Because I've talked to leaders who say, yeah, we can't make any more investments right now because we're trying to position ourselves for a sale. I would love to invest in people. I'd love to hire more people. I would love to put in some new system that's going to help us. But it seems like when you're positioning yourself for a sale, there is an incentive to cut as much excess out of the business as possible so that EBITDA number goes up. How should sellers think about that? And then conversely, how do buyers really vet to make sure that the business they're buying hasn't been just purged over the last year?
On that particular theme of sort of positioning your EBITDA or cutting costs, in general, for growth businesses, we don't really see that. A buyer, if you're running a consulting business and your EBITDA margins are 28% and norm in that sector is 17 to 21%, a buyer is smart enough to know, do you have some sort of sustainable tech-enabled competitive advantage, or have you gutted the business? Or are you billing your employees at 110% and they're running hot, and all of a sudden you're going to have culture issues or retention issues? So it's very hard to convince a buyer investor to give you credit for anomalies in the profitability profile. And if anything, people make fun of investment bankers for our add backs to EBITDA and positioning EBITDA in a different way. But in some respects, it's an easier argument to say, my EBITDA margins are impaired relative to what they could be, in a stable state over time because I'm growing fast, because I'm investing in a new geo, because I'm ramping my sales effort and going from inside sales and I'm adding enterprise sales, or I'm adding current account management program. And those are investments in the growth of the business. As an advisor, we would argue, hey, new investor, new buyer, you're going to benefit from those in a way that's not showing up in the P&L today. So since they're not generating EBITDA, let's peel it back. Let's show EBITDA non-impacted by that investment. So we spend a lot of time positioning the EBITDA, convincing investors and buyers what the steady state could be. And so we're encouraging of our sellers to quote, do the right thing for the business, and the rest will ultimately take care of itself. You do see private equity firms are holding anywhere from 3 to 10 years. And you do see certain decisions that are impacted by that hold time or availability of capital. So maybe, in the first 12 to 20 months, and this is sort of your point, O'Brien, there'll be a ton of investment in a business. Let's put in a new ERP. Let's acquire 3, 4, 5 businesses. And then as you get closer to year 4, year 5, year 6, maybe they've deployed all the incremental equity they've earmarked for that investment. So you're a little bit hamstrung from an acquisition capability standpoint, or you don't really want to be going through a geographic expansion while you're going through a sale process or implementing a large scale technological change. So there are absolutely business impacts of hold timing and exit timing for sure. But generally it's just maybe slowing a growth orientation or a change orientation versus really impairing the company.
So is it fair to say it's just cleaner, it's simpler to not have a lot of things going on externally in the business or, that's new in the business when you're trying to sell it? So you know more consistently what your costs, expenses, revenues, margin, all that kind of stuff, the more predictable you can make that right before a transaction, the cleaner it is?
I think that's very well said.
Okay. Yeah. And that's definitely a different way to think about it. From your perspective, the companies that you talk to, before you educate them on that and become their advisor, how many of them understand that and how many still kind of default to the scarcity mindset of, oh, well, we've got to make sure that we're cutting in this and we can invest in our people during this period of time? Do you see most people get it, or do you see that you are still having to do some education because human nature would be to get a little bit scarce right at that time?
There's a little bit of an education process. M&A is a good example. We'll get asked all the time, should I continue exploring acquisitions, ahead of and during a process? Again, we'll revert to the do what's right for the business for the most part. We'll talk about, do you have the right leadership infrastructure in place to get through the demands of a process while potentially buying and integrating another business? And again, there's that people aspect, just the situational demands and bandwidth demands. But assuming that's a yes, a lot of times we'll say, especially if it's been a serial acquirer, that's part of your value. Your ability to consolidate in your space, to be an acquirer of choice, however you want to articulate it, is a driver of value, and that is normal course. And for you to slow that down would actually be antithetical to what we're trying to position. So we're encouraging of that. And or every business is in some form of transition and growth, and it's an arc, right? It's not a dot at some point in time. So if you don't have the right CRO, that's fine. Talk about that and talk about how working with the new partner to find that individual will be an accelerant for growth, early on in the partnership. And that might be one thing you value about bringing on a new investor, is their connectivity and ability to help you think through management. So these businesses don't have to be perfect and pristine. And almost always a founder, the executive team, is both buying and selling at that moment, right? They may be selling 60% of their equity and rolling 40% or 50-50. And so it's maybe easier for the advisor to say, but you don't have to get everything perfect, everything right in that one monetization event.
Yeah. I was reading a book yesterday called Go Big or Go Home about how to give pitches. And it was talking about Jack Dorsey, and I can't remember the other founder's name, when they were pitching Square to investors. And one of the things that they did was they created an opening slide that said 140 threats to our business, or 140 reasons this business will fail. And the book was talking about how in most pitches like that, that was getting initial capital, but it's analogous to what we're talking about in buying and selling larger businesses too. The seller, the one who wants the investment, is trying to make themselves look as good as they can. And in a lot of cases, just lying about what's going on in their business. And then the buyers are trying to figure out what the lies are and parse through that. And it can be this very adversarial back and forth where everybody's guarded all the time. The argument the book was making was they actually were very transparent with it. And one of the things on there was Amazon targets us and takes us out. And they had that on a slide and they were pitching to an investor, and the investor said, I'm actually on the board of Amazon. And if you go with us, I can make sure that doesn't happen. And sure enough, that person wound up advocating for them within the Amazon board, and the business was left alone. And Square's a huge business today. It reinforces kind of what you're talking about, that if you are transparent, you can actually be much more collaborative and find investors who are more interested in your specific type of business, get what you're trying to do, and can actually protect you from the things that you're scared of.
For sure. And it's unlike the real estate analogy. It's a very odd dynamic because you are, quote, adversarial or on different sides until you're not. And then they make the investment and you're all on the same team. And so,
yeah, now you're partners.
Right. And so having a lack of transparency, demonstrating a difficult or challenging style, I think, is a missed opportunity. We run these multi-party processes, and we talk to our clients all the time about reverse diligence. Get to know these people. They're going to be your partners for 3, 4, 5, 6 years on your board, calling you, working with you formally, informally. I think sometimes sellers get in a mentality of, I need to be beholden to the potential investor. Well, no, they need to be beholden to you as well. They need to talk about their successes, their failures. They need to give you references for prior executives and teams that have gone poorly, that have gone wonderfully. And so to me, it's this real personal exchange process where both parties have an opportunity to feel on the people side of it and model how it would be to work together and partner. And I think if sellers think in that mindset, and because they take that risk and that vulnerability, they lose potential partners along the way, so be it. It wasn't the right partner anyway. Sort of like life in a lot of ways.
Yeah. I mean, we talk about that in the work that I do if we miss out on a deal, but the client seemed like they were going to be a nightmare to work with, like it probably wasn't a deal that you want. Similarly, I struggle all the time because we get into processes where somebody's evaluating us to be a service partner of theirs, and it is sort of adversarial at the beginning, and they won't share information. They won't share who they are, what they're trying to accomplish. They want to just vet you on paper and have you give your best pitch because they feel like they're going to be taken advantage of in some way. And I just always try to communicate, like, look, you're going to have to work with us long-term. These are long-term partnerships. We work with our clients for 5, 10, sometimes 20 years. If we're doing a good job, like, you got to like us. You got to like our people. You got to know our people, and we got to like you. We got to know you. And it just always surprises me when people take that adversarial approach to what will eventually be a very close partnership.
You bring up something for me that's very complicated as people are growing a business. You've been growing your business for years. I've been growing mine. We're measured on the revenue we bring in, the relationships. But I think there's this discounting of your gut and your intuition as well. And it's a little bit different than the sellers of business, but when you think about clients, and again, I think it does apply to sellers, trusting their gut when they're partnering. But early on, I'm sure you've had this experience, you sort of just alluded to it, when this isn't the right client for you. It's not the right business relationship, but because you're growing a business, or because I'm growing a business, we take that client situation on anyway. And 6, 7, 8 months down the road, hindsight's 20/20, it's exactly as we imagine. And so I think this people element and trusting your gut and having the courage, and it's so hard, and I still struggle with it, having the courage to say, I'm not right for you, you're not right for me, even though I'm in the business of winning clients and taking on more transactions, as are you. And even though these sellers are excited about what they can do and who they might be able to partner with, much broader topic, but I think trusting our gut, having the courage to say no because of these people elements is something we should be thinking a lot more about.
Yeah, it's just something that's totally undervalued when all the value is on the dollars and the growth and the win. It's very hard to also value the appropriateness. Does it feel right? Is this something that's going to be a good fit? Does it make people happy and motivated and committed to the cause? You know, are you going to want to show up every day and work with this partner?
Yep.
You know, if you're selling a business, are you going to want to take this new owner's phone calls every day? Because if you're not, and that's going to wear on you, it's not worth it.
It's not. And we have transactions that go less well than others, and as does any advisor. But to me, and I talk to my clients about this, you know, my goal is to, as much as possible, make the measurable stuff equivalent. Run a process where they have multiple parties at similar valuations, similar structures, and then they're choosing, right? They're walking into a relationship, not accepting one. And I think that mitigates a lot of what you and I are talking about now, where you can, you know, and it's important. It's not just taking on a client, it's taking on a partner, which is a whole different level of intensity. And so if we as advisors can deliver them choice, there are lots of different fits. Like I tell clients all the time, I think this fund would be really good for you. And there would be other clients that fund isn't as good on. Some clients need hands-on. Some clients want to be friends with their investors. Some clients never want to see their investor. And it's up to us to both directly from feedback, but also from perceiving their needs and then knowing to the very early point you made, the relationships we have, knowing how these other counterparties act and how that blend might work, either magnificently or not so much. That's another big part of our job, is the matchmaking.
Just curious, because when we think about investment banking or we think about private equity, we think about the dollars and cents. We think about the investments being made, the returns being had, and you know, you're out selling and buying businesses. But so much of what you are just talking about now is managing the humans involved in the transactions. And yes, we got to get all the contract language the right way. We got to structure it the right way and all of that. But if the people don't fit, it just creates more problems than you'd ever want to deal with. And so I guess, is that well known within your industry, or are you unique within the industry that like you're really people managers as well as transaction managers?
I would assume and hope that most folks in my position and role understand that. I probably, because I'm delivering a professional service, also selling generally professional services oriented businesses. And then on top of that, often working with founders who are doing, it's not always their first institutional round or capital, but often is. I think those things sort of stack up to maybe create a bit more sensitivity around the topic. Here at Guggenheim, over the last 4 years, I built a business, right, with my partners. We started as 2 people 4 years ago. We now have 150 and have grown. So that's also created empathy that I didn't have before of what it's like to be a quasi-entrepreneur. I'm not the entrepreneur my clients are, but I think that's probably added a little bit of empathy around all of these people elements as well. And I also just think the more comfortable you get in your role, the longer you've been doing the job, the more predictable your own success is, the more comfort you have talking about these sorts of things as well. And it becomes less the deal and more, what have I created? Who have I linked? What do I stand for? And that's a luxury, right? That comes sort of as we're talking once you also have some personal comfort in your own person.
Yeah, we talk about that too. You know, it's like the first time you turn a deal away is the first time you've finally arrived to do the job that I do. It's like, yeah, you know, you scrap and you claw and you try to get everything. But when you can finally say, you know what, that one's not right for me. It's like, okay, you've actually learned some,
for sure,
you know, and you have the maturity in the job. Let's talk about the leadership team side of this, because you've referenced that a few times. I want to go back to that. What does an evaluation look like? How do you evaluate a leadership team? Let's say you're working with a seller. What's it look like to sit with that founder or CEO and look around and say, hey, do we have the right people at the table? Maybe even, are you the right person to grow this business once this investment happens? What do those conversations look like?
So for the most part, in the actual transaction, which can take 6 months, it can take a year, depending when you start and how you're thinking about it, we generally aren't or can't change the leadership ingredients we see at the client. And so it's more, optimizing what we have. And so if you have a very overbearing, and not even in a bad way, but a passionate founder, CEO, and she or he can't help themselves when they're telling the story of the business, but they have really good people, we know that investors want there to be depth and bench and all the words they use relative to executive strength. And so maybe we'll configure a process where that CEO is spending time early with the investors, maybe a little bit more informally, and then she's kicking off a 5-hour meeting with 30 minutes on the overarching history and strategy of the business. And then we're very scripted that her CRO, CFO, M&A head have various modules. And then we're also creating opportunities for them to shine. We're also very honest. Like, again, these are all to be formed entities that are living. I have no problem. And I think it creates great trust saying to a potential investor who I've known for a decade, this is a top decile CEO and founder. He's going to be alongside you for the journey, invest alongside you. CFO is super weak. I would probably underwrite a new one, right? And that's probably too extreme. It'd probably be said a little bit differently. But again, toward this point of just being candid, being honest, we are positioning our clients, but also helping the investors see the good, understand the totality of the opportunity. And then we're also training people. A lot of these executives are used to selling their product or their offering, but they're not used to actually selling themselves or the long-term vision of the business. And so we do presentation coaching, we do dry runs, which a lot of them hate and think they don't need, but most of them do. And what are the salient position points? What should you keep coming back to? How do you interact with each other around a table, right? Don't repeat what each other are saying, reinforce. I mean, we're getting that tactical, right? And helping the team dynamics, the culture emerge through the investor dialogue that they're having.
You've mentioned CEOs, CTOs, CROs, CFOs. What about heads of HR? Because a lot of the people who listen to the show are heads of HR. What role do they have in these transactions, and how can they be a stronger partner when it comes to these types of transactions?
The role they have is, in a lot of ways, they are the finder and keeper of the raw ingredients that drive the business. What is the talent acquisition strategy? What is the training strategy? How are we creating an environment that incents our people to stay, to collaborate with each other, that gives them voice to suggest changes and elements of our business that could be optimized? And then how do we measure that? How do we take action when the KPIs around the human resource dynamic and function are telling us there are deficiencies in the business? Do we act quickly? How are we different from others in this regard? It's a really, really critical role, especially as that role encompasses, as we were saying, the finding, keeping, and inspiring of employees. That's a lot of what drives the growth of these businesses. Because also if the CRO is the best there is at sales, but there's no one to deliver against that business, it doesn't work. So these are really intricate partnerships.
How often do you see heads of HR having a seat, or I'll say maybe a prominent seat at the table? Because the HR community has some PTSD around not being as valued on the executive leadership team historically, and still in a lot of organizations. You know, if you pull up a company's leadership team online, there's still a lot of those where the head of HR is not on that sheet.
Yep. Now,
they've made progress, and they are. And I think especially through COVID, HR proved a lot of value because they were leading those responses. But you still see it, and there's still that feeling or that sense that maybe they're not included as a valuable business partner. They're just kind of like the ones who organize and keep things in order for the people. How often do you see them really having a seat at the table, and what can they do to be improving those odds if they're not there?
So it's mixed. It's certainly not consistent. I think your observation is spot on. I can't think of a situation where it was detrimental or detracting to what we were trying to accomplish to have a strong individual in that role. To some extent, I think it's indicative in a good way of the sophistication and positioning of the company if there's that individual taking a meaningful role. Like if a stage in our process is quote management presentations, and we'll have the 4, 5, 6 top executives participate in that. And if there is a human resource oriented executive in that session, I think it's a positive for comforting the investor, again, indicating the sophistication of the overall business. I do think it's a role that becomes more important and becomes optimized as companies grow versus maybe the first 2, 3, 4 executive roles that are filled, or if not even filled, just strengthened and prioritized.
Yeah. I mean, at some point in a company's journey, kind of everybody is doing everything they can to grow the business. And then at some point you need structure to that, and everybody needs more defined roles. And once that starts to happen, having a person with a skill set on how to build, function, recruit, retain, manage the employee life cycle, create an environment where people want to work, develop them into future and higher roles within the structure, like that becomes more and more important.
No question.
Yeah. So let's say a deal gets done and now we have a new owner. What are the best practices for making sure that from that date forward, you have the best odds of success?
So I think it gets to, O'Brien, one of the things you sort of alluded to is why do bankers or PE or transactions have sometimes a negative connotation to begin with? And I talk about it all the time with my clients because they talk about what if the employees find out we're doing a deal? And a lot of it depends on what type of process we're running. Are we talking to strategics or not? But relative to being the new owner, even if it's the most exciting transaction, people hate change. Everyone is intensely personal, like no kidding, right? But it's not about the company. It's about, is my job going to change? Am I at risk? Who's this new investor? How will it impact my family, my work relationships, all of it? Like it's not, especially at the moment of transaction, boy, this is exciting. It's what's going to go wrong, and to a great, great degree. So I do think coming in, sharing your plans for the business, qualitatively, quantitatively, talking about simple things. We're XYZ private equity fund. We're oriented toward growth. And if this business doesn't grow from 100 million of revenue to 200 million, it'll be a less exciting investment for us. And we want to invest in that growth. And we need double the people we have today, not half of the people we have today. So just these simple things that can start to assuage these fears that people have, I think create great efficiency at the beginning of a transaction and really drive the narrative, because otherwise it's going to be the water cooler narrative. My friend worked for a PE-backed company. It was a disaster, on and on and on. And so I think grabbing the narrative, sharing the plans in a granular way and how important the employees and the people are. And also, I don't think it's disingenuous necessarily, but even co-opting in influential leaders, right? 15, 20, work with them ahead of time. Make sure they understand the story. Make sure they understand the story to the point they believe it and are living it and are advocates for it. Like those things don't always get done because you're rushing to get a deal done, And the FAQs, the commentary, the why is this good for you often gets overlooked. And I think those that focus on that, make it a priority early, have more success, particularly early in the investment and early in the transition.
Yeah, that makes me think of two things. The first is, and we talk about this in our business, like if you're not proactively communicating the message that you want, employees are creating their own message and it's not a positive message. And so I've become a big believer in over communicating the direction you're going, the reason you're going there. I had studied communication and marketing in college, and At the time, I think it was the rule of 3. I think now it's the rule of 7, where people don't even hear the message until they've heard it somewhere between 3 and 7 times. And they don't really even understand it until they've heard it like 12 to 15 times. So there's the old adage, at the point that you start getting sick of saying it is the point where they first start hearing it. So I become a believer in that. And then the other piece is the reminder that you've gone through this transaction from the beginning. And so you've had all this time to adjust to change. And then usually right before the transaction is when you let everybody else know. And you're like, isn't it great? Because you've gone through the transformation journey, but they haven't.
Exactly.
To remember that you're now starting their transformation journey. So you have to actually dial yourself back and build them up slowly the way that you were built up slowly through the process.
That's a great way to think about it. And I think incredibly accurate. And it's a hard thing to do because those that have been part of the process, frankly, are tired of the process at that point and are ready to go on. But again, giving people the room to take the journey the key executives have is important. I also think we vastly underestimate. I underestimate as a server of clients. I think investors underestimate as a important investor in companies, how much people want to hear from us. I used to think of my CEO clients, other executives, as they're busy, important people. They don't want to hear from me unless it's sort of critical, but they want to hear from you all the time. It's lonely, right? To be, and it's confusing to be that leader, and it's confusing to be an employee that's undergoing change. And I think if we can be more deliberately cognizant of that and really understand people, and it's sort of your rule of 7, like people want to be talked to a lot and they want to hear the message and they want to feel like there's a communication channel. I think a lot of things across business go a lot more smoothly when people are actually talking out loud to each other and trying to help people figure out what's happening, making them feel heard, et cetera.
Yeah. So one more question. I have a couple more questions, but one more regarding transactions themselves, because you hear stories of deals that get to the end and then they blow up right at the finish line. So what are the things that kill deals right at the end?
Yeah, macro. Every deal we had ongoing in March of 2020 died. Yeah, as you would expect. Yeah, exactly. Or even acts of complication, right? When Silicon Valley and First Republic were going through their troubles, financing became very difficult. So that's another one. A lot of these transactions are a mix of equity capital that the investors have, but there's also a debt component. And how available is that debt? Can you get it committed? And so that can sometimes, again, it's sort of related to macro, but impair a transaction.
What about the controllables? Like, what are the mistakes that people make at the end, or things they didn't foresee or prepare for that could blow up a deal?
Client losses, right? If you're a concentrated business, and I mean, it's intuitive, but if you're going through a major contract renewal, you should probably build a process around that and make that certain. If you have a 15% client that goes bankrupt or slows their own business, it might not kill the deal, but it'll certainly change the tenor and the negotiation. Missing your numbers, we talk to clients about it all the time. Like, you want to get credit for what your business will do and perform into, but you don't want to be overly aggressive and then have to continually be rewinding expectations. The numbers are changing, but it's also hey, can you actually manage your business? Can you predict it? It doesn't seem like it. And then it just creates a lot of uncertainty. So the intra-process financial performance, O'Brien, is really important. And if you're meeting or exceeding, it's dramatically different in the dialogue you have to have if you're missing even minor misses. And so getting that sort of calibrated right is important. And any shock to the executive system, right? If something happens to a key executive, if they're poached, if there's a health issue, obviously those aren't necessarily controllables either, but that can be very impactful as well.
So you kind of touched on this earlier, but just was talking with somebody else the other day about the dynamics of how when you grow to a certain size, you can start playing not to lose instead of playing to win. And do you see that happen sometimes with leadership teams as the deals get closer to the finish line, that they start to manage their business not to lose, not to change, rather than continuing to do the things that help them get where they were and grow in the first place? Do you see that dynamic?
Not too much. What we see more is, and again, our processes are only lasting 5, 6, 7 months. It's the distraction of adding another job to your already complex day job for our clients. And imagine CEO A or head of sales B that now is spending hours and hours engaged in a marketing process, and they're not driving the business, or they're not tending to some of the smaller issues they normally would have. It can start to show up over a couple of months. So the last couple of months of a process, we often see a little bit of a stall in results or some cracks in certain facets of the business. And that's pretty normal. So that we see a lot. But if anything, doing a transaction emboldens management teams, because a lot of them are getting liquidity for the first time. They now have a partner to share in the risk. They have a lot more capital than they had previously. They have someone to help them think through capital structure and acquisition. So you're typically seeing an increase in growth orientation and aggressiveness once they get through the deal.
Okay. So a couple just rapid fire questions here at the end. What are you sick of talking about?
It probably makes me sound like an old man, but I'm already sick of talking about AI. Like the other day, someone was asking me, like, how should we incorporate AI into our business? Like, we can barely get our people to come in and get out of a work from home environment. I'm not sure how I'm going to incorporate AI and disintermediate the banking process, right? So I'm not smart enough to know if it's all hype, half hype, but it just seems to be a topic that's run rampant in the last 6+ months. So that one I'm fatiguing on a little bit.
What about the flip side? What are you either most excited to talk about, or what do you think people aren't talking about enough?
I wish people would talk more about how hard it is to be a leader, right? When we get to know these individuals, it's lonely. It's hard to say, I'm not sure where I should take my business, or this is hard. I don't know the answer, or I'm unsure. And these are all driving, motivated people that don't want to necessarily be vulnerable. So I think allowing some space for vulnerability or uncertainty is, I think, needed and helpful in these contexts, but it's very much not encouraged, not normally the experience. I also think, and it's a little bit, I sort of made the work from home comment, which was partially in jest, but the value of being in person and the connection that gets made is invaluable. And every time I get annoyed that I'm going to take a flight to go do these 3 marketing meetings, I get back on the flight grateful that I did. And I just think sort of reintroducing or reemphasizing, and it's expensive and it's time consuming. It takes a personal burden, but whether you're developing a business, the connection you make, or whether you're helping a client sell their business and the connection they can make by meeting counterparties in person, I think we should talk more about the value of that and what it sort of bridges relative to Zoom and virtual and email and all of it. And that probably makes me sound old as well, but it's just something I've noticed as we've somewhat moved back to in-person dialogue. It's just really powerful in creating connectivity and trust and perspective.
Yeah, I agree. I think flexibility is great, but I think disconnecting people from each other is bad and does a lot of damage, even if you can't really see it right away. So I agree. Last question. And as an investment banker, I'm curious to get your take on this, but I ask this to most of the guests. What in your mind is the purpose of business?
I think the purpose of business is growth. It's learning. It's obviously livelihood and earning and moving yourself as a professional. But I really think it's the interaction, it's the innovation, it's the growth, it's the collaboration, and all that sort of intentionally and unintentionally comes from that dynamic.
Clean. I like it. That's a beautiful answer. Jim, this was worth the wait. I know you are a busy man, and I appreciate you carving out some time to have this conversation. It was fantastic, and I think will help a lot of leaders think about how they approach their work, any potential transaction, and just from an education standpoint, I think this is great for a lot of people. So anything you want to say before we wrap up here?
No, I'm just grateful for you having me and for the work you're doing and really focusing on these elements. I think it's important and not necessarily always focused on. So glad you're doing it and happy to be a part of it.
Thank you. Hope you enjoyed the episode, and thanks for sticking with us.
Hey folks, one last thing before you go. If you enjoyed the episode, make sure to hit subscribe so you can stay up to date with future guests. That's it. Thanks for coming. Go make the most of your business and the people in it.